All right, what's going on, everybody? We're going to be talking about oil today, some more commodities. As you know, the global conflict with Iran has made oil prices, commodity prices go through the roof. So we're just going to sit and talk about oil. Um, you know, one thing that I really want to educate people about, and one thing that I want to make sure people understand is what really drives markets. What is the key economic driver behind why these markets go up and down in price? And as a trader, that's how we take advantage of the markets, understanding why they're going up, why they're going down, what's causing it to go up, what's causing it to go down, and then obviously getting into the skill set of entering positions, right, to take advantage of the price going up and the price going down. So let's go ahead and get right into it, guys. I want to start on the 4-hour time frame, and we'll go ahead and get rid of everything here. Okay, so from a chart perspective, we could talk charts all day, but from an economics perspective, I want to talk about a few key things, okay, to remember. A few key things, okay? Number one is supply and demand, okay? So supply and demand. Number two is global conflict. And number three is really sentimental, okay, analysis. And what sentimental analysis is basically the feeling of investors analysis about the market. So we're going to talk about duration. We're going to talk about really the effects of everything. And then we're going to talk about supply and demand and kind of some factors that to consider in the near future. And that's kind of what sentimental analysis really is. Okay. So first and foremost, we're going to start with supply and demand, right? We're going to go to a bigger chart on oil. And as you guys can see, oil, okay, the price of oil, and this isn't Brent crude oil. This is just US oil. I just like using this. I think it's just easier, in my opinion, to understand. You can look at the timelines, okay? Here's 2008. On the bottom, you guys see the timeline on the bottom there. That's 2008. You guys can see oil went from 144 a barrel to 32. We had the housing market crisis in 2008. All right. Here's COVID in 2020. Okay. COVID, we had a huge spike down because we shut down the entire world. And then what happened is we reopened the world and everybody started traveling, spending money, working, all of that. Prices shot all the way back up to a high of 130 a barrel. The reason why was because we had inflation. We had so much spending that prices got driven up because there was so much spending, there was so much demand that prices went up. Okay, so because we had so much demand, prices went up because supply was constricted. Does that make sense? So prices went all the way up to 133 in March of 2022. And then prices slightly went down. As you can see down here, we went all the way to the 60s, fluctuated between really just 60s, 50s, whatever. And that happened for about four years. Okay, so for the last 4 years, oil was good. Gas prices were okay. Now, here we are sitting in March of 2026. Now, we see a massive spike. Okay, this has never really happened to the other direction. Like, so for COVID, right, it went down. Well, now we're seeing it go up. I don't think it's going to sustain. It could go higher. Like, I definitely could see it going to like 130 or 150, but I don't think it's going to like stay there very long before it comes back down. Now, let's talk about supply and demand real quick. So on the weekly chart, we're going to zoom in here to this time frame. As you can see, we have all this previous data on the left, okay? Now, when the first signal of the Iran conflict started, we saw prices rise from 67 to 91. And then we actually came all the way up to 118 and then dropped to 78. Now, this zone, very important. I'm going to tell you why. Okay. This is kind of like supply and demand right here. Is this level, okay? You see this level that's been getting traded through for the last 4 years is an important key level. And as you can see, we went and retested that level on the chart before continuing to go higher. And the reason why is because price had to rebalance before going higher. At first, the market overreacted, right? We drove all the way up to 117. It came cratering down, not only taking out leverage positions, but rebalancing price before continuing higher. The market had already put in and had already basically predicted that the Iran conflict in the Middle East was going to be for a longer duration. And that is why we saw a rebalance and a continuation higher. Now, as you can see, it rebalanced it perfectly. We came right back into what we call demand. So there was demand at $79, $80 a barrel. Right? We went all the way to 119. The market rebalanced. And then now we're actually driving up higher in a balanced fashion where you're actually seeing continuation of the chart going higher. Okay. So supply and demand is very simple. To understand it from a simple perspective, you have the suppliers who gather the oil, who put it in tankers, and then who sell it to Exxon, Energy, right? All of the monopolies in the world. And so where do you mine oil? Where do you get it from? You get it from Russia. You get it from South America. You get it from the United States of America. And you get it from Europe. So everywhere, and the Middle East. So everywhere that drills for oil, okay, produces oil and supplies the oil. Now, who demands the oil? Number one, the businesses. The businesses demand oil. So the gas stations, the electrical companies, the energy plants that use oil to power the entire planet, basically. And then the consumers. So we are consumers, right? We travel, we run businesses, we drive cars, we fly on airplanes. All of these things needs oil. So it's a demand, okay? There's a demand for oil. Now, the conflict in Iran, to understand it like this from a supply-demand perspective, is the Strait of Hormuz, obviously, it transfers, it's the transportation for 20% of the world's oil supply, okay? When the supply got disrupted, meaning they weren't letting any oil tankers through that strait, that basically means 20% of the supply was getting cut off completely. Now, what do you think that does to price? If the demand stays the same, okay, then prices go up. Because the supply goes down, the demand goes up, prices have to go up in price. So the price of oil per barrel has to go up in price because there's not enough supply to fulfill demand because it's now constricted. That is the simplest way I can explain it to you, and that is why prices are going up, if that makes sense. So now we're going to talk about global conflict. And actually, the two tie together. So supply and demand and global conflict, they tie together. Because of the Iranian global conflict with the Strait of Hormuz and the war that got created in the Middle East, the supply and the demand got changed and it shifted. So now we have less supply and the same demand. So now prices go up, and you have a numerous amount of factors that occur from the supply getting cut and the demand going up. Okay. Now we talk about sentimental analysis. So now we have to think, okay, here we are in March. How long is the Middle East confrontation going to continue? How long is it going to last? When is the Strait of Hormuz going to open back up to allow all traffic to go in and out to be able to move oil, right? Because it's 20% of, guys, 20% is massive. 20% is a huge number when we're talking about billions and trillions and millions. So 20% is a significant amount, okay? So from an investor perspective and from a supply and demand perspective, now we have to consider the sentimental. And this is what investors do. This is what hedge funds do, institutions do, fiduciary advisors do, financial analysts, economists. You have to look at so many factors to consider what the next move is going to be. If it looks like the global conflict, so the Iranian conflict, the Middle Eastern conflict, if it continues to escalate, more missiles, more drones, troops on the ground, oil will continue to go up. It will continue to go up because now the duration has just gotten lengthened, if that makes sense. Now, if we start to see ceasefires, if we start to see negotiations, if we start to see policies getting created and countries coming together, right, to create a better environment and not continue to fight a war, then that's when we'll start to see oil come down in price. Now, usually the markets are pretty forward looking. They're always trying to be ahead of the curve, which is why it's sometimes difficult to know exactly when the sentimental analysis is driving the market, so to speak. So, what we're going to be looking out for is, like I said, negotiations, ceasefires, peace talks, and really just as long as we see no missiles getting fired or no troops on the ground, I do think oil will come down. If oil continues to go up, the last thing we're going to talk about is the effects. Okay? We've talked about supply and demand. We've talked about global conflict, how it impacts supply and demand. We've talked about sentimental analysis, the duration, okay, of prices going higher, right? Now we're going to talk about the effects. So these are really they're not what ifs, but they're just likelihood. They're basically projections, like the likelihood of this happening because of this, okay? So the effects of oil going up is inflation and a really, really hurt economy. Consumers are paying more at the pump. They're paying more for flights. So it's going to be more expensive to fly, which means airfare tickets are going to go up. It costs more money to transport goods and services. If you run a business, if you run a restaurant, if you run any sort of business that requires oil, you're going to be paying more for produce. You're going to be paying more for transportation costs. What does that do? It raises the price of goods and services. So now we have inflation in play. And with inflation comes very, very bad consequences. We're talking about potentially printing more money. We're talking about potentially really defaulting on our debt. I mean, declaring bankruptcy as a nation. We're talking about the bond market coming into play. We're talking about global debt being an issue, right? So the effects of this, they're not good. There's nothing good that comes from higher oil prices. Okay, and this is very important to understand. And guys, everything is affected by this, and that is why it's really important to understand what it is. We're not just paying higher prices at the pump. This is affecting the global economy. It's affecting everything. Okay, so now we're going to talk about what to look for. The good and the bad effects, like not the good, but the potential things that could happen, and then really we're just going to pray and hope that prices come back down and that we see a ceasefire and that we see non-escalation in the Middle East and that we see countries come together to really deter the continuation of the war in the Middle East. If prices go up to $150 a barrel, which is all the way up here, okay, which is all the way up here. If prices go up to there and they stay up there at 150, we're going to have a global recession. We're going to have bankruptcy. We're going to have people have to tap into their 401ks. The stock market's going to go down, right? Because people are literally taking all their money out just to be able to pay for life. Everything's going to go up in price. And you know what? At that point, we might have basically another 2008 or just a great depression. If prices come down in the near future, if prices can come back down to the 60, 78 level, if we can see a ceasefire, if we can negotiate prices, we will basically be able to recover a lot faster from rising prices, people getting fired, and a global recession. So it's very, very important that oil prices come down. So it's out of our hands. It's out of everyone else's hands except for global leaders and really just negotiation. Just hope and pray that we have intelligent people running the world, because it's going to take a team and a village to keep this shit together, I assure you. Now, last thing we're going to talk about is how to trade this. Really, really simple. If we're in an uptrend, we want to stick with the trend. You can trade liquidity concepts, you can trade Fibonacci retracements, or simple supply and demand concepts, simple support and resistance, and really just pullbacks, like any kind of pullback. I personally like to trade liquidity. How we trade liquidity is as prices continue to move up, right? So this was volatile. You can't really trade that shit. It's very volatile, but this you can trade, right? This is shit you can trade, okay? How you trade that is liquidity. So we mark up zones of liquidity. Okay, so these are liquidity points where there's sell orders and buy orders, okay? And you take the session time that you're trading, whether it's London, New York, and you target liquidity. So if there's resting liquidity, you're gonna wanna target that. Now we go down to the 1 minute, and here we are at 8 a.m. So boom, first liquidity point gets met. Obviously, we take out this one first. So guys, very simple. Okay, 8 a.m.'s here, New York session. New York session begins, 8 a.m., boom, right? We have liquidity here, liquidity here, liquidity here, liquidity there, liquidity there. Every time liquidity gets taken, you look for the pullback to the previous liquidity that gets taken. Boom, liquidity taken here. We pull back to previous liquidity taken, we move higher. Liquidity gets taken, we get the retest, we move higher. Liquidity gets taken, we don't get the retest here, we move higher. Very strong uptrend. Very important to notice, extremely strong uptrend, okay? That means that, and you can go look at the sentimental analysis, right? Like, boom, US crude oil inventories rise more than expected. Why? Iran warns neighbors of energy site counterattacks. So guys, literally the whole thing's in the midst of getting disrupted, okay? Boom, liquidity gets met, we go long, we go to further liquidity, boom, comes back down, retests previous liquidity, and guys, you can see these highs, like you can see these points, they're getting hit and they're getting used as pullbacks. They're getting used as support for pullbacks to target further liquidity. And then we continue to look, right? We have resting liquidity here. These are orders, these are stop losses. Boom. Where does price go? From previous liquidity all the way up to this one. Boom, we hit there. Where do we pull back to, guys? We pull back to previous liquidity right here. Boom, you go long again right here. You go long. So this is how you can trade this kind of market. It's volatile because of obviously the global, confrontation, and you just trade from liquidity to liquidity. That's all you want to do in this kind of market. Now, if you're in a downtrend, which we had yesterday's market, we were in a downtrend. So if we go, just for an example, if we go to 8 a.m. yesterday, the market was in a downtrend. What was it doing? It was basically taking out any longs before going higher. And you mark it up like this, okay? And we'll get rid of this one actually. No, it's actually fine. We'll leave that. And look how much liquidity got taken during New York session yesterday, right? We came down, took liquidity, came up, came down, took liquidity, retested the previous liquidity, came down, took liquidity, retested the previous liquidity, came down, took liquidity, came up, came down, took liquidity, came all the way back up, taking out what? More liquidity. We take out sell liquidity here. We take it out here. We fill the imbalance. We go lower, retest one more time, take out the last little bit, and then we continue our uptrend this way. Does that make sense? And then during Asia session and London session, so basically Asia session continued to take liquidity here, here, here. So in my opinion, this is the best way to trade it. This is the best way to trade it. And then, it depends if you're a swing trader or a, basically like a long-term trader. If you're going to swing, you want to zoom out and just trade simple supply and demand concepts. Basically RBS, right? Resistance becomes support. Then you go long here. So it's really just understanding, one, the fundamentals, and then two, understanding your approach. And that's basically where we're at right now. So we'll continue to talk about it. I'll continue to make videos on really, what to expect. If anything changes in the near term, if we get, any news or data on ceasefire or escalation, we'll continue to post about it. So I hope you guys enjoyed the video. Leave a comment below what you thought. If you have any comments or concerns or questions, let me know down below in the comment section. Hit that subscribe button, and I hope to see you guys in the next one. Take care.